Welcome to The Explainer. Today, we're embarking on what I like to call the quest for the true bottom line. We're going to completely decode IAS 33. That's the International Accounting Standard for earnings per share. You know, when we look at a company's financial health, we usually just stare right at that giant profit number on top. But honestly, that's kind of like looking at a massive, delicious corporate earnings pie without knowing how many people are waiting in the next room holding a fork. To truly understand the value of a single share, you have to know exactly how to slice that pie. So, let's dive into this.
So here's a classic dilemma for any financial analyst. How do you actually accurately compare the performance of two vastly different companies? Imagine a lean, super agile startup generating $1 million in profit and then a mega corporation pulling in $100 million. Pure profit numbers just don't tell the whole story. Because if that startup only has 100 shares outstanding and the megacorp has $1 billion, well, suddenly the startup's individual shares are looking a whole lot more attractive, right? We need a great equalizer.
And that great equalizer is IAS 33. This standard lays down the absolute, strict principles for figuring out and presenting earnings per share, or EPS. Its whole objective, the entire reason it exists, is to improve performance comparisons between different entities in the same period, or even the same entity across different periods. So while measuring the actual earnings is obviously crucial, what IAS 33 really obsesses over is standardizing the denominator, the share count. That is what makes these direct comparisons possible.
Okay, here's our roadmap for today. We're going to cover 1. The core objective, 2. Basic earnings per share, 3. Understanding diluted earnings, 4. Tricky potential ordinary shares, 5. Handling retrospective adjustments, and 6. Presentation and disclosure. Let's get right into it.
Starting with Section 1, the core objective, focusing on the denominator. Like I mentioned, IAS 33 states that having a consistently determined denominator is absolutely crucial for financial reporting. It's all about getting that share count exactly right.
Moving right along to Section 2, Basic Earnings Per Share, the starting pie. This is your baseline calculation, representing the current reality of the company.
Looking at the core formula, it's not just total profit divided by shares. Actually, it's profit or loss minus preference dividends divided by the weighted average ordinary shares. We have to deduct those preference dividends first. Why? Well, because ordinary shareholders only hold a residual interest. Basically, they only get what's left over after all those guaranteed payouts have already been made.
Let's break this math down into two buckets. On the one side, we have our numerator, our profit, adjusted for those after-tax preference dividends. On the other side, the denominator. Now notice it says time weighted for the period. This is super important because a company's capital changes. If a company issues 1 million new shares on December 1st, those new funds only help generate profit for a single month of the year. It'd be completely unfair to divide the whole year's profit by shares that barely even existed during that year. So IAS 33 requires this time weighting factor based on the actual days those shares were outstanding.
But what happens when things aren't so simple? That brings us to Section 3, Understanding Diluted Earnings, or as I like to call them, the hidden guests.
So, basic EPS is your current reality. It's the actual shares outstanding right now. Diluted EPS, on the other hand, is your absolute worst-case scenario. It forces a company to calculate what their earnings per share would look like if every single financial instrument that could be converted into an ordinary share actually was converted. Ultimately, diluted EPS exists to protect investors from nasty dilutive surprises down the road.
So who exactly are these hidden guests? The standard lists a few common sources of dilution. You've got convertible debt, bonds that can magically transform into stock. You've got convertible preference shares. You've got options and warrants, which are often handed out to executives or early investors. And you've got contingently issuable shares, basically shares waiting in the wings to be issued if the company hits certain performance targets. They are all just lurking in the background, fully ready to expand that denominator.
To establish if one of these potential shares is actually dilutive, IAS 33 uses a specific benchmark. Let's anchor this with a concrete example right from the standard. Imagine a control number of CU 4800, representing profit from continuing operations. A company uses this control number to see if a potential ordinary share will actually shrink the EPS. If converting those shares causes the EPS tied to that CU 4800 to drop, boom, it's dilutive, and it must be included in our worst-case scenario calculation.
But wait, there is a massive exception here: anti-dilution. Anti-dilution is when assuming a conversion actually increases the earnings per share or decreases a loss per share.
Think about it. Maybe converting a huge chunk of debt saves the company so much in interest payments that the profit jumps up way higher than the share count expands. Well, IAS 33 has a very strict rule for this. If it's anti-dilutive, you literally just ignore it. The standard only wants to show you the worst-case scenario, absolutely never an artificially optimistic one.
Handling those exceptions naturally leads us into Section 4, tricky potential ordinary shares edge cases. Things like options and contingent agreements definitely require some accounting gymnastics.
Take options and warrants, for example. Here's exactly how we handle them. Step 1, we only care if they are in the money, meaning the exercise price is cheaper than the current average market price. If they are, we pretend they're exercised. But we don't just dump all those new shares into our calculation. No. Step 2, we assume the company takes the cash it would get from the option holders and uses it to buy back its own stock at the average market price. We only look at the difference, the incremental shares issued for basically no consideration. Step 3, we add only those incremental, free shares to our denominator. It's honestly a brilliant way to capture the true dilutive economic impact.
All right, now we get to my personal favorite part. Section 5, handling retrospective adjustments, or as I call it, time travel accounting.
The standard is super clear on this rule. The number of ordinary shares outstanding before the event is adjusted as if the event had occurred at the beginning of the earliest period presented. Okay, so what does that actually mean? Well, if a company does a 2-for-1 stock split today, suddenly everybody has double the shares, but the company isn't actually any richer, right? If we just blindly compared this year's EPS to last year's, it would look like earnings plummeted by 50%. To fix this, IAS 33 literally forces the company to travel back in time and restate all previous periods as if that split had always existed. It's the only way to make sure our year-over-year comparisons remain perfectly valid.
Finally, we reach Section 6, Presentation and Disclosure, showing your work. Because it's not enough to just do all this math behind closed doors.
Companies are forced to show their work to the public. These numbers must be presented directly in the Statement of Comprehensive Income. And a company has to give equal prominence to both basic and diluted EPS. You absolutely cannot put the good number in big, bold font and go hide the diluted number in tiny footnotes. Also, and this is a big one, they must present these figures even if the EPS is negative. A loss per share has to be broadcasted loudly and clearly. Finally, they have to provide a full reconciliation of exactly how they calculated the numerators and denominators, instrument by instrument. Transparency is completely non-negotiable.
So, as we wrap up this explainer, I want to leave you with a final provocative thought. We are all so conditioned to chase the profit, right? That massive numerator. But after decoding IAS 33 today, you know that the true story of your investment's value is often hiding right there below the line. Are you looking closely enough at the denominator of the companies you analyze? The next time you glance at an earnings report, I challenge you to look for those hidden guests, the potential dilution, and the true bottom line. Thank you so much for joining me on this explainer, and keep learning.